Hello there, and many thanks for joining us on this fresh edition of Business Week, the program that brings you top business stories that made the headlines during the course of this week, including special news features, market data, interviews, and much more. Welcome to the show. Well, here's the highlight of some of the biggest stories we tracked for you over the course of this week. Now, on the local front, the Nigerian National Petroleum Company Limited has made it clear it would no longer remit any money to the Federation Account Allocation Committee for sharing to the three tiers of government monthly. It said this is based on its latest transition from a public corporation to a limited liability company, and that it currently owed no money to FAC as all monetary affairs and arrears to the committee were owed by the old corporation and not to the new oil company. And one of the biggest stories we also had during the course of this week, the Central Bank of Nigeria's Monetary Policy Committee, in a fresh move, concluded its MPC meeting for this month with an upward review of its benchmark rate by 100 basis points, moving the MPR to 14%. And now Nigeria's inflation rate rose in the month of June to its highest level in more than 5 years, fueled by the rising prices of food and high energy cost. The inflation rate surged to 18.6% in the month of June, which is up from the 17.71% which was recorded in the previous month of May by the National Bureau of Statistics. Now, the new rate is the highest the nation has recorded since January 2017. And I'll bring you the latest from the international front. Importers of technology products from China paid over $32 billion worth of tariffs imposed by President Donald Trump between mid-2018 to the end of 2021. A new trade report showed earlier within the week as the President Joe Biden administration continues to deliberate over whether to remove some duties. And now within the energy sector, the European Union is set to also carry out emergency plans as well and activate these plans to reduce gas demand within the coming months, warning countries that without deep cuts now, they could struggle for fuel during the winter if Russia cuts off deliveries. And one of Goldman Sachs' most senior bankers in Asia, Todd Leland, is also leaving the region to become the president of Goldman Sachs International. It's now time to bring you special packages prepared by our correspondents.
Over the years, Nigeria's electricity industry has suffered operational and institutional lapses, which has rubbed off on many other sectors of the economy. The deplorable situation led to the privatization of the power sector in 2013, but this did not solve the problem of erratic power supply that has greatly impacted on economic growth and development. At the Senate's plenary, lawmakers considered a report of the Committee on Power to repeal and reenact a new legislation to provide an institutional framework for the post-privatization phase of the electricity industry.
This bill seeks to consolidate all legislation in the Nigerian electricity supply industry and enact an Omnibus Electricity Act to provide for the ideal institutional framework that will guide the post-privatization phase of the industry. After the privatization, issues have arisen that needs an electricity act that take care of issues that were not anticipated in the first place.
After an extensive consideration of the report, the Parliament dissolved into the Committee of a Whole for a clause-by-clause analysis of the bill, and then the bill was passed.
The time has come, Mr. President, for us to take the courage and look at some of these policies, especially privatization that was inherited by this government. A situation where our collective wealth is given to some few people. Now, I hold the strong view, Mr. President, that government must be looking at what the common man will benefit.
Renewable energy production is encouraged, or whatever it is. Call our attention so that we slow down to see what how the law will encourage whatever we wish.
With this bill, states can now generate their own power and would also be able to issue licenses to mini grids. The bill also expands the powers of the Nigerian Electricity Regulatory Commission to also regulate the industry and enable it align with global best practices. If the bill eventually gets Mr. President's assent, it will, among other things, attract investments across the Nigerian electricity supply industry, eliminate barriers to power generation, transmission, and distribution, and also improve the living conditions of Nigerians. Tijesu Adeoye, TVC News.
Motorists in Nigeria are having a hard time filling their tanks with the premium motor spirit, otherwise known as petrol. Perpetual scarcity and high cost of the product have become the order of the day in the midst of dwindling incomes and skyrocketing prices of commodities. Attempts by the government to remove subsidy on petrol over the years have not been successful. Yet, determining the exact consumption rate on a daily basis has been near impossible, and there has been a steady rise in subsidy running into trillions of naira. The House set up this ad hoc committee to dig into the subsidy regime between 2017 and 2021. The committee promises not to be swayed.
This unhealthy development is a tragedy that must be stopped and the perpetrators brought to book if we are to make the sector attractive to compete favorably with the rest of its members or member country.
But the key figures critical to executing the mandate are glaringly absent here.
I am displeased by the even attendance of those who are within the field. That's the beginning, I thought, of what you should have hammered on. And I think I have shown my displeasure, and on behalf of the House, my displeasure for those in authority who are supposed to be here to come and account for what they have done on behalf of Nigerians. Their absence speaks volume.
At the technical session, the Independent Petroleum Marketers Association of Nigeria exonerates its members from alleged diversion of the product. It suggests that anyone found diverting or smuggling petrol should be treated as criminals.
We were removed from every information. That is to say, even the current composition of the directors of that board, Ipman is no more there. And how do we get information?
The committee says it will not hesitate to issue warrants of arrest against any chief executive who declines his invitation the next time. Jokeyatsa, TVC News, Abuja.
For the sixth time, the national electricity grid has suffered yet another collapse, throwing many homes and businesses across the country into total blackout. The solution to improving the power supply has been an unending question for years, with little or no result. With plans to diversify energy sources, the Nigeria Energy Forum organized a conference focused on boosting investment in climate-smart energy infrastructure and modern energy technologies to boost the power sector. With its partnerships with other countries, the stakeholders believe it would help to aid economic development as well as improve other sectors.
One thing that we offer that I think is the greatest asset that we have in Canada is the ability to deploy experts and provide technical assistance. And so this is something that hopefully we'll be able to explore with our Nigerian partners going forward.
Sustainable energy is critical to addressing some of the grand challenges that the world faces today, from a better recovery from COVID-19 impacting health, the economic cost of living crisis, and how cheaper energy sources, sustainable energy sources that can help drive economic growth and productivity.
With the present level of power generated to businesses, stakeholders say the country is more than ready to diversify to using renewable energy.
There is a clear policy on renewable energy. Renewable energy, energy efficiency, and renewable energy action plans. The government has put that in place.
What we need to do as a country is have an imaginative approach. But we need to unlock the capacity of Nigerians, both at the investment level, both at the technical level, both at the operational level, for them to solve this power challenge.
Now that the national grid has been resolved and the Senate has passed a bill for each state to generate electricity while also giving a legal backing to renewable energy, this may just be the change Nigeria needs to improve the energy sector. Inioluwa Popola, TVC News, Lagos.
And now it's time to bring you the feature on the show today as we take a look at Nigeria's Treasury bills and bond market performance. We have details of this and much more after this short break. Don't go anywhere. Stay with us. Let's now deal with the crux of today's discourse. Now, Nigeria's Treasury bills and bond market has also seen quite an interesting play. Nigeria's high inflation rate is permitted in the presence of negative yield in the fixed income market, and nonetheless, the Central Bank of Nigeria's Treasury bills for a one-year tenor were oversubscribed by a whooping 527% in the month of June. Also, according to the Debt Management Office as well, there has been a listing of about $1.25 billion worth of Eurobond on the Nigerian Exchange Limited and FMDQ Securities Exchange Limited. Well, joining me now virtually to discuss the trends and intricacies we've seen in the Treasury bills and bond market, I have with me Gafar Bashir, Senior Associate, Global Market, and he works with Parthin Partners. Thank you very much for joining us on the show today, Gafar.
Thank you so much.
Well, let's now start off with some school of thought around the government's preference of Eurobonds at high interest cost and with the associated exchange rate risk, which may likely hurt Nigeria sooner than anticipated. What's your take on statements like this?
I'm not sure I would agree with that, or at least as of today, as of 2022, that the Nigerian government has preference for Eurobond borrowings. If you asked me this question this time last year or even 2020, I would have agreed with you, and for good reasons, anyways. So what I'm trying to say is that since developed economies by the US and the EU embarked on quantitative easing programs where they flooded the market with cash in an attempt to combat the impact of COVID-19. We saw yields in the international market and Eurobonds market generally crashed, basically, or trended downwards, and which provided ample opportunity for emerging and frontier markets to governments to access funding at these low rates, right? And that's the reason why we had seen significant borrowings by lot of African countries in starting from Q3, Q4 2020 down to Q3 2021, right? However, since the US Fed, the US Fed and other EU central banks, the ECB they've commenced and announced and commenced the reversal of the quantitative easing programs where a hawkish stance have been where they adopted a hawkish stance. We've started seeing a reversal in the trend of yields. Yields have been trending upward, and which has generally discouraged emerging market governments to tap into the Eurobond market and Nigeria. And we'll see the same for Nigeria as well. I mean, since year to date, we've only seen the DMO tap into the Eurobond market to the tune of 1.25 billion, and that's not significant. 1.25 billion, which amounts to about 525 trillion naira. And when you compare that with the approximately 2.6 trillion that was budgeted for foreign borrowings this year, you would agree with me that would not exactly qualify the current stance by the federal government as preference for Eurobond borrowing.
And now, despite the increase we've seen in the benchmark monetary policy rate by the Central Bank of Nigeria, we saw that in May, and then we've also seen this latest move this month as well, just a few days ago. Nigeria's Eurobonds for long-term instruments still hovered above 10%. Some market analysts had hoped that investors in Nigeria's fixed income market may benefit from the rate hike with adverse effects expected in the equities market. Do you think this is yet to be seen as well?
We expect the MPR hike to impact the fixed income market, but just the local market for the most part. And maybe it's understandable if you expect an adverse effect in the local equities market as well. But for the Eurobonds market, I would not expect the MPR rate hike to impact the Eurobond market, given that the monetary policy rate is a benchmark, a key policy rate for the local markets and for local investors. In comparison or in contrast to the Eurobond market as for international investors. However, even for local investors, following the announcement of the MPR hike, a 150 basis point hike. We saw a knee-jerk reaction of about 30 basis points on the long end of the Naira yield curves. So that's, I mean, I'm talking of 30 year paper. We saw yields trend upwards from 13% to about 13.3% levels. And for shorter dated papers, we saw maximum of about 60 basis points. It wasn't significant and it was short-lived as following auctions by the DMO and the CBN suggested that the federal government and the central bank is not exactly prepared to incur higher borrowing costs than we currently have, right? And there are other factors that ensures that or that ensures that yields in the bonds market does not rise too much. One of which is the introduction of the secondary market charges by the SEC of 0.05% of secondary market transaction in the fixed income market. This generally discourages secondary market activity and kind of stems volatility. So what you have is that PFAs and other fixed income market players, big players, asset managers would rather go to the auction than trade in the secondary market. So going to the auction means there's significant demand, which keeps borrowing costs low for the federal government.
And let's also look at quite some interesting plot here. We also see the Debt Management Office releasing its federal government of Nigeria bond issuance calendar for the third quarter of this year. A plan which is aimed at raising between the range of 630 billion naira and 720 billion naira in the next 3 months. What do you make of this move?
The issuance calendar that was issued by the DMO for Q3 is essentially identical to the one that was adopted for the second quarter of 2022. However, we do not expect to have the same outcome, right? And in Q2 2022, we saw high level of subscription in at the auctions, right? At the bond auctions. For every the bid to cover at the auction was about 1.7 times as compared to 1.17 that was seen in Q1 2022. And going into Q3 2023, we would not expect to see as much demand as we've seen. Going into Q3 2022, we do not expect yields to go higher or significantly higher. Instead, we actually expect to see a reversal in yields, a downward trend in yields. And the reason for this is a couple of reasons. One is the fact that as at the end of H1 2021, the DMO has achieved, the federal government has achieved about 55% of its planned local borrowings. It set out to borrow about approximately 2.6 trillion in the local market, right, at the beginning of the year, and then a supplementary budget that brought its local borrowing targets to 3.6 trillion, right? And it has, out of that target, the DMO has achieved 1.95 trillion naira of that, which is about 55%. Now, that suggests that they've achieved a significant proportion of that. And we understand that if the federal government access borrowings from other means, most notably is the CBN ways and means to the federal government, which means they most likely wouldn't tap the entire local planned borrowing in the public market, right? So and like I mentioned before, factors like the PFA's aversion to participate in secondary markets and preference for primary market activity would ensure that production would have demand and would keep borrowing costs low for.
Okay, now let's try to place pundit here and I'll make some forecasts, especially within the Treasury bills and bond market as well. The CBN Treasury bills for the 1 year tenure were oversubscribed by a whopping 527% just last month. What twists and plots do you see coming to bear in the last 2 quarters of this year, as we also set our sights on the year 2023?
Well, one major factor that has determined how the fixed income markets, the activities in the fixed income market the past couple of years past few years is the CBN unorthodox policies, essentially, right? One of which is the borrowings to the federal government through ways and means. Now, so long as that continues, the CBN continues its unorthodox policies, which we expect to be the case. I mean, it's just a few months to the elections of this current administration, where this current administration is expected to leave government. There's less incentive for current trend or current pattern to change, right? So we still expect to see significant the CBN bailing out the federal government in by means of borrowing them funds by the Ways and Means window, right? And which, like I mentioned earlier, we would see a downward trend in yield. We expect to see a downward trend in yield in treasury bills and also the bond market in the second half of 2022. We have significant coupon payments that is expected to drive that. About 678 billion is expected in coupon payment in Q3 and 259 in Q4, right? So all of these factors is expected to ensure that yields continue to trend downwards. The only opportunity for twisting is if the CBN decides to, I don't know, change their stance from unorthodox policies to try to normalize activities within the monetary policy, in their monetary policy. Then that might just be the surprise that market participants could see in the coming months.
Okay, now, what's really now your word to investors as well, sitting on the fence, especially for speculators who are overwhelmed with pessimistic market sentiment, and which haven would you also be pitching to prospective audience who are yet to get into the market and waiting for a little bit of wooing?
Well, this, despite the current economic realities, right, and pessimism that might be contagious or that might be that you might perceive as a result, right? There are still opportunities for investors to take advantage of. I mean, for retail investors, one thing that's one the statement and principle that has stood the test of time is cash is king, and like we already know, this given the effect hawkish stance where rates policy rates are being hiked. The impact on the Nigerian Eurobond market means yields have been trending upward. So Eurobond papers might just be a good opportunity for retail investors in Nigeria to take advantage of, because one, it gives them access to higher yields than they will get. I mean, comparable papers in Eurobond for Eurobond as to local for the same maturity local papers is has higher yields than local papers, right? And not just that, it also gives you a form of currency devaluation hedge, right? You'll be able to hedge your currency risk. So not just the fact that you'll be earning good yields, you also be hedged from devaluation risk that might occur within the span of the remaining months of the year. So yeah, I would recommend European retail investors in Nigeria to take advantage of the Eurobond market this period.
Thank you so much for your time on the show today, Gafar. It's been a pleasure speaking with you.
Thank you so much.
Well, just before we go now, here are graphic details of the Consumer Price Index for the month of June as prepared by the National Bureau of Statistics. And that's it on this edition of Business Week. Many thanks for watching so far. To enjoy the rest of your weekend, I'm David Alabi. Bye for now.